Hello, everyone. I'm Mark Rutstein with the Evan and Mark team right here at Compass. And we are here, I think this is episode number 8, maybe, with our Ask the Loan Officer series. Today we have Billy Kinberg from MVB Mortgage. Hi, Billy.
Hey,
how are you?
Good. How are you?
I'm wonderful. Thanks for joining us today. We're going to talk about a few different kinds of loan programs. We have a good amount of sellers that are trying to figure out how they can buy their next property before they sell their existing home. So we're going to cover a little bit of the bridge loan process. We're going to talk about construction loans and also some portfolio loans. So first, a little bit about yourself, Billy.
Sure. I'm a local guy. Grew up in Rockville, born and raised, went to the University of Delaware. I've been doing mortgage loans now for 14 years. So I live 5 blocks on one side of your office, and I work 5 blocks on the other side of your office. So,
all right, so you know this neighborhood?
I do indeed.
Wonderful. Let's start with some bridge loan action. You want to explain what that is and what your company has to offer on that?
Sure. A bridge loan is a unique product that helps buyers or people that are transitioning from one home into another. Okay. So in a perfect scenario, a buyer would wake up one day, go to breakfast, go to settlement and sell their house, walk away with this big fat check, maybe go to lunch, back to settlement on their new house they're buying, and then go out to the home in the sunset, and the credits start to roll while the moving trucks pull off, right? That's the
that always happens, right?
Yeah.
Right?
But of course, that's not always the case, especially in a market where inventory is so low. Very often, you'll have buyers that need to sell their property before, need to buy their property before they sell it. And that becomes a problem on 2 fronts. One, all their money for down payment on the new house could be tied up in their existing house. And the other problem exists on the end in purchasing the new loan. You may not qualify for that new loan while you're still carrying the debt from the old loan. And a bridge loan helps solve both those 2 problems. So let me give to sort of help see how it works, okay? So the first bridge loan we call a traditional bridge or an exit bridge loan, okay? And this loan would be on your existing property. So let's give an example. Let's say you own a home that's worth about $600,000, okay? And let's further say you have a $300,000 loan on that property. So you've got about $300,000 in equity, okay? We want to tap into that equity as a cash out to use as a down payment on the new house, okay? So with the exit or traditional bridge loan, we can lend you up to 75% of the value of that house. So 75% of the 600 would be a $450,000 loan, right? Your existing loan is $300,000, so that gets paid off. And
okay.
$150,000 less closing costs, cash coming out of that to then go and buy your new house, okay? That's the traditional loan model, okay? So now I've got the cash out. Now the advantages of this exit or traditional bridge loan are, one, that we can do this loan on a property that is currently on the market for sale, okay? Or if it's been on the market. And one of the problems that people run into is when they can't sell their home and all of a sudden they need to get that cash out to buy the new home, is they think of maybe get a line of credit, right? Well, nobody's going to lend on that property to give you a line of credit because you're not going to be living in there any longer, and it's been on the market. They know that it's been for sale, okay? So the second example of the bridge loan goes a little bit further. Now, the second bridge loan is what we call an acquisition bridge, okay? We used to call it cross-collateral, but technically that term is no longer accurate, so we don't really call them, we call it an acquisition bridge, okay? So this bridge loan is going to be on the new property. Here's the reason why we need this loan. Let's say you were able to get the money out of the house you're selling, whether by bridge loan or some other means. Maybe you already have the cash. Doesn't really matter. If you cannot sell that house before you buy the new house, the problem you run into is with the new financing on the new house, you're going to run into the issue of underwriting when it comes to one of the basic thresholds of any underwriting test, which is called the ability to repay that new loan. Okay, we measure this ability with a metric called the debt to income ratio, or DTI. Okay, and what the DTI is simply a simple fraction, your total monthly obligations, which include all of your home payments, car loans, student loans, any other installment loans you have, and all the minimum payments on your credit card. Okay, it doesn't matter whether you pay them off in full or not. It's just those minimum payments. Okay, we add all that up and divide that by your total monthly income. That's all your income before all the deductions. Okay, that ratio needs to be within a certain threshold. Different loans have different amounts. Typically, we say 45%. That's sort of the industry norm of what we say is sort of an average. Okay.
Sure.
Okay. Typically, if you are trying to buy a new house and you're still carrying the debt from the old house, very few people have the income to support both those payments, both the new housing payment.
Correct.
And the housing payment. So the purpose of the acquisition bridge, and again, just to describe what the acquisition bridge is, this is another temporary loan on the new house up to 80% of the value, in which we can often ignore that debt to income ratio going above norm because we know that it's based on waiting for the old house to sell. So let me give you another example for the acquisition bridge. Okay, so you're moving out of that $600,000 house. Let's say you're buying an $800,000 house. Okay, so you've already got the $150 cash out coming out of the old house. Now I'm giving you a bridge loan of up to 80% on the new home. Okay, so again, it's an $800,000 house. So an 80% loan would be $640. We've got the $150 coming over from the other house. So now we've got a total of $790,000 in two loans coming to you. Okay, all you need to come up with is $10,000 out of your own pocket, which you can get from a number of different sources, plus costs, and you're now in the new house. The old house is on the market. Mark's doing a great job of selling that house for you while you're moved in. No stress about finding a temporary place to live between two houses. You move in and you're in waiting for the old house to sell. Now, when the old house sells, what's going to happen is obviously that $450,000 bridge loan is going to get paid off with the proceeds of that sale. Remember, it was worth $600,000. You had a $450,000 loan on it, right? After closing costs and commission paid, let's say you walk away with another $100,000 after closing costs, say you get $550,000. So you walk away with $100,000. That loan's paid off. Now what we're going to do is we're going to restructure you into another loan, a permanent financing loan on the new property. Now, all along, we have qualified you for this permanent financing on the new home. Okay, so from the very beginning, we said, okay, what type of loan do you want on the new home to be your permanent financing? Do you want a fixed rate loan? Do you want an adjustable rate loan? What do you want? And we qualified you that based on an interest rate that's typically a little higher than the market rate at the time, not because you're going to get that higher interest rate, but because we have to assume rates are going up, that you may have to pay a higher interest rate when it comes time to transition to that new loan. Okay, so once the old house sells, we're now ready to originate that new permanent financing on the new home, and that will pay off the temporary bridge loan on the second home. And now you've got your permanent financing going forward. And that's how the bridge loans work.
Well, that's a whole lot of information for a lot of people to
It is, I know.
absorb.
That's what I'm here for. I'm here to help people understand how that process works.
Yeah, it can seem very overwhelming. So if you're in that situation where you want to investigate more about how it works or be explained to again, then just shoot us a message or comment below, and Billy will come back and give you some more examples. Maybe throw up some graphics.
I have, if I can share my screen with you, I actually have a nice little animated PowerPoint slide that sort of shows how it all works together. So we've actually put that together. I'm happy to share that with anybody.
Love it. I love it. Maybe we can put that down in the comments.
Great.
As always, the contact information for our guest lender will be in the comments so that you have that and you can reach out to them, but feel free to put some comments down on Facebook, and we will reach out to you. Let's talk about construction loans.
Sure.
If I am buying a property that is a little ugly, the kitchen doesn't work for me, and I want to make improvements on that, then do you have anything to help me? Because I don't have the money after paying for my property to renovate my kitchen.
Sure. So last week you talked about the FHA 203K renovation loan, which is a great product. We offer that as well. But sometimes the FHA 203K has some limitations. One, it has a limitation on loan amount, right? The FHA limit is $679,650, which is often good enough for a lot of properties. But here in DC, a lot of times you'll spend almost that much money just to buy the property. Your renovation costs may go over that. So that's a bit of a difficulty. The other limitation with the FHA 203K is that you have to hire a FHA inspector to help guide you through the process. So that's an extra person involved in the process. You have to pay his fees, okay? And third, FHA limits, unless you're doing the limited 203K, which is a very small loan amount. But if you're doing the regular full-blown 203K, you have to use an FHA approved builder, okay? Without construction.
If we're talking about condos.
What's that?
If we're talking about condos, right?
Actually, I believe with the full, I could be wrong, but I believe with the full-blown FHA 203K, you need to use an FHA approved builder. I could be wrong about that. That was
Got it.
that I have. Okay.
But you can use that program for condos and for houses.
Yeah, absolutely.
Okay, got it.
Okay. But with our construction renovation loans, we are not limited by loan amount. We can lend up to well over $1 million, well over $2 million. Of course, the loan to value is reduced at those amounts. Okay. But the way we are going to lend on this product, the beauty of it, the fourth limitation of the 203K is that at the very end of the day, we end up with an FHA loan, which again, for some people with better credit is not the loan you want carrying forward as your permanent loan after construction is done. Okay. With our construction and renovation loan products, you get a temporary loan throughout the construction process. It's interest only throughout that process at a fixed rate. Okay. And when the construction or renovation is done, we'll modify you again into permanent financing of whatever you want. Again, whether you want a 30-year fixed loan or just whatever you want, we will give you that permanent financing, take care of it. So again, the way the construction renovation loans work, and there are two different ways that we can look at construction renovation. The one is if you already own the property. The other is if you were acquiring the property as part of the transaction. Okay.
Okay.
So in your scenario, you're buying a house that needs some tender loving care. Okay. So again, let's say we're buying a property that costs us $500,000. Okay. And we need to put $300,000 worth of work into it to make it the perfect property for us. Okay. So it's a total of $800,000 acquisition and renovation. We will lend up to 80% of that amount. On an exception basis, we could go higher, but basically we're talking about an 80% loan to value. So we're lending you, again, $640,000. That covers the $500,000 purchase price plus $140,000 towards the renovation. You've got to come up with 20% of your own funds. Okay. All that money gets put into an escrow account, and the builder will draw from that in stages. The building process will draw from it in a draw schedule. Over time, as he's completing the renovation, you're only paying the interest on that which has been drawn to date. So the $500,000 for purchase plus whatever let's say he takes 5 draws to use up the rest of the money, you'll only pay the interest on the outstanding balance. Okay. When the construction is complete, we are going to modify it to a new permanent financing, whatever type of loan you want. Okay.
Okay.
Now we can also use the same type of loan. Let's say you want to buy a plot of land and build on that. Okay. Same thing. We can use the acquisition cost of the land is $100,000 plus $500,000 build price. We'll lend you 80% of that $600,000. Same process. Okay. Now, the beauty of the renovation loan is even better when you look at the other side when you already own the property. Either you already own the land or you already own the property which you want to renovate. Of course, this isn't so great for you because you're really not part of this process. This is great for you to recommend for clients that you bought houses for in the past that now want to renovate, okay? If you already own the property, we are going to lend you up to 80% of the value of the property after the renovation is complete. So again, let's use the same scenario. Let's say you have a $500,000 property with a $300,000 loan, okay?
Right.
And let's say you're going to put that same $300,000 of work into it, okay? But now let's say, so the total is, again, a $300,000 loan plus $300,000 worth of work. So that's $600,000 to lend you. 300 to pay off the old loan, okay? But let's say this property is going to be worth $1 million after the renovations are done. We'll have an appraiser come out, look at the property and say, okay, he'll look at the drawings and the plans. And they'll say, okay, well, you do all this work to it, this is going to be worth $1 million, right? So we're going to do 80% of that $1 million. So we're going to give you up to $800,000. You don't need 800, you only need 600, but we're literally 100% of the money you need, so you don't have to bring any money out of pocket except for the closing costs to get this loan done. And again, when it's done, we'll you into a permanent loan of whatever you want, whether it be 30-year fixed, just rate, whatever. So that's a real power.
Yeah, that sounds like a great product.
And it's the same thing if you, let's say you already own a plot of land and want to build on it, okay? You already own the land, so again, we'll pay out, if you have a lien on it, we'll pay that off. But it takes $500,000, but the property is going to be worth $1 million because the land has value. Again, we're going to lend you 100% of that money to build the property.
I like that.
Yeah. Very powerful.
That's a good option over using a HELOC, which is a home equity line of credit on a property that you already own because you might not have enough for your renovation in equity.
Right, exactly. Because the HELOC is going to be based on the value of the property as it is now before the renovation. So in that example, you've got a $500,000 property with $300,000 loan. You've only got $200,000 worth of equity. No bank's going to give you 100% of it. They'll give you 90% of it, maybe. But that's not enough to complete the renovations. So you've got to come up with a lot of money. Yep.
That's a good program. I like that.
Great program, yes.
Let's talk about, we hear a little bit about portfolio loans from time to time. And I think that I run into some scenarios from time to time that maybe a project isn't Fannie Mae or Freddie Mac warrantable. Is that a good example of what you would use a portfolio loan for?
That's actually usually our first example, okay?
Okay.
So to understand a portfolio loan, first I want to explain what happens with normal loans. Okay, a normal regular loans anyhow, are typically originated by a lender like us and then sold on the secondary market to one of the three agencies. Most people have heard of these: Fannie Mae, Freddie Mac, and Ginnie Mae. Now, these are the primary investors. They buy loans from lenders, bundle them, put them on the secondary market for sale on Wall Street, okay? And then that gives money back to the lender, then we want to make the next loan, okay? So by far, the majority of all loans go through this process, okay? Now, to do that, to be able to sell to these investors, okay, we have to meet those investors' guidelines. They have very strict guidelines, and our loans must meet all those guidelines before they will accept them and sell them. And we want to sell them, okay? One of the things that Fannie Mae, Freddie Mac, and Ginnie Mae, which are FHA loans and VA loans, are put their restrictions on are condos, okay? When you want to buy a house, okay, we are going to underwrite you, the borrower, and your financial profile, but we're also going to underwrite property itself. Now, typically the appraisal gives us all the information we need to know about the property, its value, whether or not it looks like it's in good shape and so forth. But with a condominium, we're talking about a whole different other animal, right? You're buying a unit within a building that's being shared with lots of other people. It's actually a little miniature company, right? We want to make sure the company's being run right. Okay, we want to make sure that the homeowners are in control. Okay, so things that will make a condominium non-warrantable are: one, if there are too many investor owners in the property, because we want owners to take better care of it than investors.
Yep, that's right. Investor ratio.
We want to make sure that no single person or single entity owns more than 10% of the unit, because then they have too much control over the property. Okay, we want to make sure that there's not too much commercial space in the project. A lot of condos being built today with a level of retail, which is great. It's a great amenity for the people who live there, but we want to make sure that those retailers don't have the control of the property, and it's less than 25% of the total square footage. Okay, there are a lot of other things that make a building or a condominium warrantable, non-warrantable. Okay, and excuse me, if the condominium does not meet these guidelines, then Fannie will not buy these property or buy these loans from us. So therefore, we cannot, lenders that only sell to Fannie Mae and Freddie Mac and Ginnie Mae can't do loans in these type of projects. The portfolio loan, on the other hand, that we offer allows us to overlook these and do loans in these properties.
I like that. I like that. I like that extra option. Definitely who you work with matters. We take a lot of steps before we go under contract to see, if we're going to run into these issues. If the investor ratio is high in a condominium building, we try to find out whether or not there are a lot of delinquencies of condominium dues outstanding. And usually the listing agent should know a little bit about that. But us on the buyer side, we, in many cases, will call over to the management company and just say, hey, are we running into any issues here? On top of that, we know a lot of the buildings around town that has the higher investor ratio. So it's nice to know that there's another product out there that we can send these people to if the investor ratios are over, let's say, 40 or 50%.
You bring up a great point there. I think it's very important that when a listing agent does a listing on a condominium, that they find out that information first. Are they going to run into snags with regard to warrantability of the condominium, limiting the pool of who can buy it based on who can get a loan on it? And they need to make sure that they know who to recommend or who has a portfolio and they can refer to if the buyer comes along and they can't get financing on their own.
I love it. That's great. Billy, we are out of time today, but I just wanted to say thanks for stopping in and joining us.
Thank you so much for having me. It's been great. I love the show. I've watched every episode, and I think it's great. I think you do a great service to the community.
I love it. Thank you. We planned on doing that up until spring market. A lot of people have a fear about calling a lender or getting in front of them. So hopefully this is helpful to those people. The spring market is basically here, and it's pretty tough to find property. Inventory is still low. We have somewhere around 40 listings coming on. So reach out to us if you are interested in knowing what we have coming soon. In the meantime, I'm Mark Rutstein with dcrealestate.com. Right here, Evan and Mark, team of Compass. Thanks, Billy. Happy Friday, everyone.
Thanks so much, guys. Take care. Bye-bye.